Susie, for entrepreneurs that want to sell their business to a private equity house, how does that change deal structure at all?
So quite materially, if you're selling to private equity, I think the common thing is it looks quite complex. The reason for that really is that private equity structures are very highly leveraged. So often you'll have a kind of a multiple holding structure. But I think that complexity is the same in every deal, if that makes sense. So whilst it might look complex, if you've not seen it before, most deals look the same. But for people selling to private equity, typically they will sell for cash, as always, hopefully with the expectation of getting capital gains tax on that. Mm-hmm. They will then be asked to reinvest a proportion of their proceeds into the new buy structure. And the reason for that, obviously, is that private equity houses don't want to run your business for you. They want management to continue to be invested in the business and therefore to own a proportion of it.
Is that where the term rollover comes from? Okay.
Exactly. And the rollover is probably because often with these structures, as I said, will be multiple holdco structures. That's where the tax people get excited and where we give our advice on ensuring to the extent that you want to the extent that your money stays in that buy-side structure, that you don't pay tax to the extent you've not taken money out. But the question then, I think, is what does that consideration look like? And there's lots of terminology around it. So like institutional strip, for example, and that's because these vehicles are highly leveraged. Mm. So what I mean by that is that the investor will put in, say, 100. Of that 100, 90 might be debt and 10 might be ordinary share capital. Mm-hmm. So when you reinvest, Emma, as a manager, you will also invest pari passu. So a lot of your investment will be in that institutional strip. So you'll take some debt investment and you'll take some ordinary shares. And that debt might be preference shares, which for us are like debt, or it might be loan notes.
Is there anything else with regards to a PE deal that's different from a trade deal that we need to be thinking about today?
So on that reinvestment, I think we would expect management to reinvest in a PE deal 25 to 50% of their proceeds probably, mm-hmm. and the majority of that into that institutional strip, so into this mixture of debt and equity instruments. In addition to that, what you've got sweet equity. Now, sometimes you hear the term sweat equity, but more commonly in the UK, sweet equity. And effectively what that is just ordinary share capital that managements are either given or given the opportunity to acquire in the business. And that might be between 10 and 20% of the entire ordinary share capital in the business. That sweet equity is very valuable in the sense that you don't have to buy the accompanying debt. So you can acquire quite a large percentage of the business at a lower cost than, for example, the private equity house. Because of that, because it's an employment-related security, by which I mean you work in the business, we have questions about what the value of that is. So from a tax perspective, a big part of our work is what are the employment tax consequences for our management teams of reinvesting into that new structure.
Susie, thank you so much for today. Really insightful thoughts. And if anybody needs any help with understanding the tax implications on selling their business, please do either give myself or Susie a call. Thank you.